Good morning, everyone. My name is Gordon Richards. I am one of the directors at our Business Services Division here in Perth. I would like to welcome everyone to our first webinar. We are going to be running a series of webinars over the coming months, coming year, probably every quarter. They will probably vary a little bit, but the intention is to run every quarter. As an example, our next one, which I'll touch on later in the webinar, that our next one's going to be on probably around the 12th of December. Hopefully everyone is joined in okay and can hear me all right. If you do have any issues, if you can please contact Shane. Shane's our marketing manager here in Perth. I think she did send out an email yesterday with everyone's or with a guide. So if you have any issues, please email Shane. She's on standby, waiting to help. There will also be there is also a guide in the resources section of the Zoom meeting. So if you touch base or if you click on the button at the bottom of your screen, that should give you a few tips on how to get things started and get things sorted. But yeah, if you have any issues, please touch base with Shane. So today we are going to run through employer obligations and tips and traps, basically. So effectively, how I'm going to run it is I will start going through the first part of the slide or slides, which will be on superannuation and paying super to employees, how it's calculated, and all that side of things. I'll then probably have a bit of a pause and just look through a couple of the queries and answers or Q's and A's in the Zoom webinar, and I'll answer as many as I can. And then I'll go through again and go through the rest of the notes, which will be on fringe benefits, tax and entertainment and gifts and that side of things. And then I'll do the same again towards the end and look at the queries and answers again. So I think everyone's microphones should be muted. So if you do have a question, please type it into the Q&A section and I'll touch base on those halfway through and then again at the end of the webinar. I'm hoping to go for roughly about an hour, maybe a little bit quicker, and then I'll go through and have a look at some of your questions along the way. So we'll get started. So I'm just going to share my screen quickly, and hopefully you can see my slides okay. So I'm hoping everyone can see those slides all right. So everyone will get a copy of the slides after the webinar. The webinar is going to be recorded and we'll probably send out a link to the recording afterwards as well. So feel free to share with other staff, with other contacts or associates. Yeah, happy to share it around basically. So yeah, as I said, we are going to go through employer obligations today. We'll start on the superannuation side of things and then work into fringe benefits basically. So as I'm sure most people know, superannuation is a requirement for any employer, where it is currently paid at 11% of an employee's ordinary time earnings. So that ordinary time earnings or OTE is actually defined by the ATO, by the government, and I'll touch on that a little bit later. And it's pretty important that we all know and that we understand what those OTE or ordinary time earnings is. I find a lot of the time with some of our clients, there's a thought that superannuation is just paid on all wages, not necessarily the case, and we'll run through why that is. So super's historically been at around the 9-10% mark. I'll show you here just the history of where it's gone from. So back in 2013, it was at around 9%, moved up to 9.2, then stuck at 9.5 for quite a while. We're at that point now, and as you can see, it's slowly making its way up towards 12%. So from 1 July 2025, it's going to be at 12%, and then the plan is to stick at that level for a while. So that's obviously the 12% of the ordinary time earnings. Okay. Payments of superannuation have to go to a complying superannuation fund. So if you've got an employee here that says, oh, I've got a super fund over in the UK or overseas, that doesn't necessarily comply with Australian law, then that is an issue, and that's an issue for the employer. So it's your obligation as an employer to make sure that the fund that you're paying to is a complying fund. It has to be paid and reported electronically. Look, it's hard to do that or to not do that now, given most programs are electronic and with single touch payroll and everything these days. So that's a standard. There used to be a minimum threshold on which you didn't have to pay super. So historically, if someone earned less than $450 a month, you didn't have to pay super on that. However, that has changed, and it is now mandatory from the first dollar that someone gets paid. So looking at the ordinary time earnings definition, this is directly from the ATO website. Basically, ordinary time earnings are earnings in respect of the ordinary hours of work, other than earnings consisting of a lump sum payment made to the employee on termination. So it looks at what the ordinary hours of work of that employee are. What's their normal working hours? What's the standard in the industry, and how does that tie into what hours your employees are working? Obviously, if there's other sort of lump sum payments, as the definition says, then it is not included. So when someone leaves and they get paid out their annual leave, that's not included as ordinary time earnings. Okay. The second part of it is it says that earnings consist of over award payments, shift loading, or commissions. Okay, so over award payments are basically where the award will say that someone is to be paid X dollars per hour, but you as an employer choose to pay them more than that, basically. Okay, so even though it's above what the award is stating, you've still got to pay superannuation on that amount. Shift loading is where someone might get paid a higher wage or a higher hourly rate because they're working outside of their usual hours. And then commission, as we know, is where payment is dependent on them selling certain products or achieving certain KPIs, basically. Okay. So this next sort of diagram stroke picture basically just indicates that an employee's ordinary time earnings is not necessarily the same as what their total salary or wages is. Okay, so there are potentially some components of some components of an employee's salary that do not constitute an OTE, that aren't ordinary time earnings. Okay, and the biggest example of that is overtime. So if an employee is working overtime, then technically you as an employer do not need to be paying super on that overtime. A lot of the time employers choose to anyway, because as we know, getting staff these days is quite difficult. And so if you turn to a staff member and say, you know, I'm not paying what was super on your overtime, and you limit the amount that you are paying them, you know, they could very easily go to your competitor and get paid that superannuation as well. So, but it is still important to note that your ordinary time earnings are not necessarily the same as your salary or wages. Looking at the ordinary hours of work, so just going back to that definition again, it specifically says the ordinary hours of work. So what are the ordinary hours? Okay, they're basically the hours that are generally specified under an award or an agreement. So with a lot of things with employing staff, your fallback would be looking at the award. So the award is something that is basically defined by Fair Work Australia, which sets the minimum standards for employing staff within a certain industry. Okay. You don't necessarily have to use that exact wording. Okay, so it doesn't have to look at exactly what the wording is saying, what the award says. Sorry, but you need to draw a genuine distinction between what someone's ordinary hours are and hours on top of that. So we look at what their normal, you can see down here what their normal, regular, or customary hours are. Okay, and any work or any hours in excess of those ordinary hours are not OTE. So I'll just show you an example in the award. So I've just got an award up here. I've just picked the Road Transport Award. And this just goes through all the different sort of things that you as an employer need to abide by. Okay. It defines what's a full-time employee. It defines every part of employing a person in the road transport industry. Okay. So if you look down within these awards, you'll see in here, there's a section which talks about hours of work and the ordinary hours of work that an employee is due to work. So if we click on that one, it will go in and it basically tells us what those ordinary hours are. Okay. So the ordinary hours of work in this award are basically 38 hours within a work, not within a work week, not exceeding seven days, basically. So within a 7-day period, ordinary hours are set to be 38 hours. Okay. And that's basically your fallback is where you're not sure of what someone's ordinary hours are. Your first point of call would be to go and look at the award. Okay. What we do need to be careful with, though, is even though the award might specifically say that the work hours are 38 hours a week, if it's normal or regular or usual or customary to work longer hours than that, so if someone turns around and says, well, I'm a truck driver. Truck drivers are a little bit cautious because there's a lot of enterprise bargaining agreements or specific agreements with employers, but whatever the industry is, and the award says they're only working 38 hours a week. But realistically, across the whole industry, it's standard, it's normal, it's expected for them to say work 40 or 50 hours a week. Then even though the award defines it as 38 hours, really the true ordinary hours are more likely going to be that 40, 45, 50 hours, basically. Okay. So you've just got to be very careful there in terms of what's the ordinary hours of work and what is defined as ordinary time earnings. Okay. So as I sort of touched on before, payments that are specifically included as ordinary time earnings are over award payments. So that is one where the award might turn around and say the minimum hourly rate is $30 an hour. But because you're trying to attract good staff, you're paying $40 an hour. it's still the $40 an hour is still included as your ordinary time earnings. Okay, so that is what your payment should be based on, because that's an amount over what the award is stating. Shift loading, if someone gets paid a higher rate to work after hours, to do night shift, anything like that, that's specifically included as ordinary time earnings. And then the last one is commission. So commission is not necessarily someone's base salary, but it is still a form of remuneration to that employee. And so it's specifically included as ordinary time earnings. Another thing that you need to be careful of as an employer is actual versus purported ordinary time earnings. Okay, so, and this is what I was sort of touching on earlier in terms of what the normal working hours are. So the ATO are aware of some awards or agreements, and I did have a look, but I couldn't really find any to show you this morning, but they're aware of awards or agreements which might try and specifically define what ordinary time earnings are. Okay, so the award might go and say ordinary time earnings for the purposes of paying superannuation are 38 hours a week. But as I said, in industry standard, industry norm, it's common knowledge that the ordinary hours or the normal hours are actually 45 hours a week. Then even though the award tries to define what that ordinary time earnings is, really you need to be paying it in line with what the standard ordinary hours are and what the expected hours are. Okay. So just be careful. As I said, your award is generally your fallback. That's what you should always rely on, but doesn't always necessarily mean that if someone's normal hours are 45 hours or different to what the award is saying, then really that is something that you should be paying super on. Okay, so as you can see, it's a bit of a minefield in terms of what you should be paying super on, but I think really is try and as best you can figure out and determine what your ordinary time earnings are, and then realize that that's really all that you should be paying super in. Okay, and it's a good check to just, this diagram is a good sort of fallback where, you know, most people think whatever I pay my employee, that's what I need to pay super on. Not necessarily the case. You can choose to do that, but as far as the ATO is concerned, that it's not, you don't have to, basically. Yeah. I'll touch on when superannuation payments are due, and I'll be honest, this is probably one of the biggest things that we come across with our clients where there are shortcomings. Superannuation, I think, is probably one of the biggest areas of audit. Actually, I can say in my experience, it is the biggest areas of audit coming from the ATO. We do get quite a few payroll tax audits, but that's a state-based one. But in terms of what comes from the ATO, superannuation is the biggest audited area that I'm aware of. And most of the time, it's due to late payments. Okay, so the ATO have multiple different resources available to them now, where it is very, very easy for them to track what super is being paid and when it is being paid. Okay, so as we know, with single touch payroll and all your payroll programs, your wages is reported to the ATO every single time you click pay or you click process that pay run. So the ATO can see exactly when you're paying your staff and what super is due on that pay. Okay, they obviously, well, with single touch payroll 2, they can now go into the different components. So it's a lot easier for them to work out what that ordinary time earnings are, but they can definitely look at the timing of it. The same with paying your super as well. Through SuperStream, you need to now, as I've touched on at the start, you need to advise the ATO or pay your super electronically, which means that all the ATO needs to do is cross-match what your wages is showing to what your SuperStream is showing, and they can automatically and straight away tell whether it's severely under, and there might be a reason why it's under, but they can definitely tell why it's so far, or that it is so far under, and more importantly, they can tell the dates straight away. Okay, so superannuation has to be paid at least quarterly. You can choose to pay it more often than that. You can choose to pay it weekly, you can choose to pay it fortnightly, you can pay it monthly, but at a minimum, it has to be paid quarterly. And the due dates for superannuation payments are 28 days after the end of each quarter. So you can see there that obviously the September quarter, we're at 28th of October, December is 28th of Jan, March is 28th of April, June 28th of July. So if you are one day after that date, if you pay it on the 29th of October, there's an audit risk there. Okay. And I'll touch on in a second the risks associated with late payments. And at the moment, they can be quite severe. So my advice to all of my clients is do whatever you can to pay your superannuation as soon as you can, or definitely before those due dates. So what happens if you are late? Okay, as we know, cash flow is difficult at the moment, or in a lot of industries, it's very difficult and it's hard. And so there will be times, or hopefully not, but there may be times when you are late. If you're late, what the requirements are is that you, as an employer or your accountant, us, whoever it might be, should be lodging what's called a super guarantee charge statement with the ATO. And what that is basically doing is it's going to the ATO and saying, I was late, this is what I should have paid, this is what I have or haven't paid, and coming clean with the ATO. So it's a form that we fill out that basically lists all the employees, all their super fund details, and what super was owing to them, and if you have paid it, what was paid. Okay. Those forms then automatically calculate what's called a nominal interest charge, which is at 10%, and a $20 per employee admin fee stroke penalty. Okay, so if your superannuation is $1,000 for, call it, 2 employees, the amount that you're going to have to pay with the superannuation guarantee charge is the $1,000 for those 2 employees in super, an extra $100 being the 10% interest, okay, assuming it's 10% per annum, so it will vary depending on when you lodge it, and a $20, or the $40 in this case, being the $20 per employee multiplied by the 2 employees. Okay. That interest is calculated from the end, or from the due date of when the super was due until the date in which we lodge the SGC statement, regardless if you have paid that super or not. So I actually had a case, it was probably about a year ago, where a client of mine actually paid their super. It was a day late, and they got audited about 12 months after that. So they paid their super 1 day late, and that interest component, that 10%, was calculated from the 28th of January, call it, until the time at which it was audited, because that's when the SGC statements were lodged. So the super had all been paid, albeit a day late, but they still got charged interest for that time period. Okay, so as you can see, it's pretty hefty. And with that interest, it's actually legislated that there is no ways that can be remitted or reversed. It's impossible for the ATO, and this is a change in law, to get rid of that nominal interest. So with those super guaranteed charge statements, what happens is the employer will pay that SGC to the ATO with that interest component and with the $20 fee. The ATO collect it all. They pass the super and that 10% interest onto the employee's super fund. Okay, and the ATO keeps the $20. So that $20 is like a processing fee as such, but the 10% goes to the employee, the 10% interest. And that's the purpose for that is it's supposedly lost earnings on that superannuation. Okay. If I found a super fund that is making 10% earnings, I would probably look to change my super to it, because 10% in a 10% return in any investment at the moment is pretty good. So it's, as you can see, it's very much a penalty rate. Those payments to the ATO, that SGC is not tax deductible. Okay, so if you are late with your superannuation and you have to lodge one of these SGC statements, it's not tax deductible. Okay, so it's ordinarily, as we know, we would get a deduction for super. SGC is not deductible. Okay. With superannuation generally, it is deductible when it's physically paid. Okay, so we get a lot of clients, particularly around 30 June when we're doing some tax planning work, where we will actually go to them on, say for example, their last pay run is on the 20th of June. So they've got 10 days between their last pay run and the end of the financial year. We will actually turn to them and say, pay that superannuation up to the 20th of June before the 30th of June. Okay, so what that means is that as at 30 June, they've only got one final pay run where they haven't paid the super on it, and that can be paid in July. And that just means that we're bringing forward that tax deduction from what would normally be in the following financial year because it's paid in July, but we bring it forward into June because it's deductible when it's paid. And technically, it's deductible when the payment is received by the super fund. So, you've just got to be careful with like BPay transactions or EFT transactions that take a few days. I wouldn't be paying it, you've got to be cautious if you're paying your super on the 28th of the following month when it's due. Should be a couple of days before, and particularly around 30 June when you're trying to get that deduction. Directors can be held personally liable for super. So this is a whole nother topic, but there's an area called director penalty notices, where directors can, or as we know, a company has great asset protection, and any sort of liability is kept in that company. There's a few circumstances where any party can look through that protection and chase the directors personally. Okay, and that is unpaid GST, unpaid PAYG, and unpaid superannuation. Okay, so if you as a director don't pay your super, the ATO can chase you personally and chase your personal assets, basically. Okay. So penalties with not paying your super, and just penalties with superannuation in generally. So the top one is reasonably new as far as I was aware, or as far as I'm aware. The ATO had a bit of an amnesty period probably a couple of years ago now, where they were trying to get as much superannuation paid as they can. So they turned around and said, if everyone pays their super between this date and this date, they had to still lodge SGC statements, but it meant that the superannuation was deductible. Okay, so it was pretty big enticement for clients where they knew that they were up for that 10% interest charge. But if they came clean and lodged it all, they would get a deduction. That is no longer, and they've now introduced this Part 7 penalty, which is where the penalty is equivalent or can be equivalent to 200% of the SGC. So going back to that previous example where there was $1,000 of super, $100 interest plus the $40 worth of admin fees. So what's that? 1,140. You would have to pay that and pay another, call it $2,500 of penalties on top of that. So you can see that they're fairly severe. So the ATO are well aware that superannuation is one area that is very commonly missed and needs to be given its due attention, because if you don't, you'll get hit with a 200% penalty. There's also an admin penalty where you pay less than the superannuation guarantee than you're required to, and this is more when you're making a false or misleading statement. This one's hard to put a figure on it, but it can be the base penalty can start at about 75% of the shortfall, but it ultimately depends on each person's circumstances. So if you've got a horrible track record with the ATO, they're more likely to impose that full penalty or higher. Whereas if you come clean and say, hey, look, the mistake, won't do it again, and you've never had any issues before, then there's some avenue of negotiation there. General interest charge. So general interest charge is an interest that the ATO charges on unpaid debts. So going back to those SGC statements, arguably you can pay the 10% nominal interest, which that goes to the employee. And then if that amount stays unpaid for a period of time, you get charged general interest on top of that, which is currently 11.15%. So it's huge. There is avenue to remit that general interest, but we're finding it harder and harder to negotiate with the ATO. Through COVID and everything, it was fairly, the ATO were very forgiving, and we often had some success with remitting general interest charge. Those days are gone, and it's a lot harder to do now. We need genuine reasons why we want to remit that interest. Okay. And then there's a few other penalties. Look, these wouldn't come up too often, I wouldn't think, but just important to note. So there's a choice penalty. As I'm sure you would know, whenever you hire a new employee, you have to give them along with the normal TFN declarations and things, you need to give them a form which allows them to choose their superannuation fund and tell you where to put their super. If you don't give them that option, if you don't give them that choice, then there's potential penalties there. Okay. Failure to keep tax records, failure to provide the TFN onto your super fund, and the likes also come with penalties as well. Yeah, I haven't seen any of those, to be honest, personally. So they're there, but probably not as common. Whereas I think this top one, that Part 7 penalty, I think will be more and more prevalent moving forward. The ATO is getting tired of chasing people for unpaid super, and so they are becoming more and more ruthless with that. As I mentioned at the start of the presentation, there is no minimum amount on which super is to be paid. So it used to be $450 a month. That's no longer. You have to pay it on every cent that you pay to your employee. There is a maximum. Okay, so there's a term called as a maximum contribution base. Okay, and this is the maximum amount that you as an employer need to pay super on. Okay, so it gets changed every quarter, I think it is. It's either every quarter or every year. but it's the maximum amount you need to pay super on is 62 grand. So it's just over 249 grand a year. Okay, so theoretically, the maximum amount that you have to pay in super is $6,850. Again, you don't have to abide by that, and I can't say I'll have much clients that do abide by it, because if you've got an employee earning 280 grand or above that threshold, and you turn to them and say, no, I don't have to pay you any super above this amount, I'm not going to, I suspect they'll be looking elsewhere. Okay, so yeah, not common. Most of the time people pay it on everything, but theoretically, you only need to pay it on the 62 grand a quarter, sorry. Lastly, with the superannuation side of things is reportable employer super contributions, or RESC. Okay, so RESC is a figure that is reported to the ATO on an employee's earnings summary. It used to be called pay-as-you-go summary. Now with single touch payroll, it just goes through on their earnings. All that RESC is it's a figure that's reported to the ATO that they use to calculate various other government payments. So Centrelink payments, childcare, I think it's included when working out any HECS payments, things like that, because effectively what they're trying to do is stop people reducing their salary in order to maximize those other benefits. Okay, so say for example, if someone's getting some form of Centrelink payment, they might turn around and say to the employer and say, okay, well, you're paying me X amount, please reduce that and just put more into my super fund. Okay, and what that achieves is it effectively means that their taxable income is lower, which means that they may get more income from Centrelink. With RESC, what happens is whatever amount is paid into super at the discretion of the employee is recorded as RESC. Okay, so if an employee turns around and says, okay, well, I'm getting my 11%, I'm planning for retirement, or I want to maximize my Centrelink benefits, can you put 15% in my super fund instead and just reduce my wage? That extra 4%, or the dollar figure on that, is reported to the ATO as RESC. So when the ATO or when Centrelink are looking at it, looking at what the payment to them is, or what their HECS repayment is, they look at what their salary is plus their RESC. So it effectively goes back to where it should have been in the first place before that employee chose to do it. Okay, so from the employee's point of view, it doesn't affect their tax at all, their income tax. It doesn't affect their taxable income. They don't pay tax on that amount. It's just reported to the ATO to adjust for those other benefits or other obligations. Okay, and it's important to note that only that excess over the 11% is reported. Okay, you don't have to report the full amount; it's only the excess. But again, with all the modern payroll programs and single touch payroll, they will likely report it for you, and it will be calculated for you. Okay. So as long as you've got your payroll program set up correctly, it will go through it and it will report that figure to the ATO correctly. So that's the end of our the superannuation section. So I might take a minute and just go. I can see there's about 4 questions in the Q&A section that I'll touch base on quickly. So that first one, are RDOs paid out at termination considered ordinary time earnings? That's a good question. I would guess they would be, because again, it's it's a payment that's a lump sum payment, basically. I will just share, I forgot to do this earlier, apologies, but on the ATO website, I've got this here, there is a list of payments that are considered ordinary time earnings, and it goes through and it actually defines what's a salary or wages. So going back to the little diagram with the circles, and what's ordinary time earnings. So the first one you can see, overtime, is salary wages, but it's not OTE, which means we don't have to pay super on it. So actually looking on roster day off, RDOs, I'm just looking here to see notice. As I said, I would guess that they would not be OTE because it's a lump sum payment, as a leave payout would be. But I'll keep that on there. And what I might do is I'll do some research after the webinar, and with the notes that come out afterwards, I'll give you the answer on that. Okay. Asunta, you've put, does the employer require to pay the super if the employee works under 30 hours a week? I'm pretty sure they do. I don't think there's any minimum threshold anymore. There used to be, but as far as I'm aware, there's no minimum amount anymore. Okay. The next one is, if you pay super but it's late, do you still have to pay all the super to the ATO or only the interest and fees? Good question. So what happens on those super guarantee charge statements, you list all the employees and what super was owing to them. There's then another box, which I think is called a late payment offset, which is effectively the amount that you've paid already. Okay. So going back to that example that I had where you've got 2 employees totaling $1,000, if you haven't paid it all, you pay the full amount, being $1,000 plus the interest and penalties. Whereas if you fill out that late payment box, then you can actually, it will reduce it by that amount. So in effect, you're only paying the interest and penalties. So you don't have to pay that superannuation again, if that's what you're getting at. The next one is, we occasionally get a payment bounce back because they've changed funds or the fund has changed. Should we lodge a form if it's bounced back? Another good question. This sort of stuff, it comes down to everyone's risk perception. I think if you can prove that you paid it well before the due date, and it would have been paid on time, but for an error from the employee or an error by the super fund, I think you're probably safe. Okay. If it's an error made by you or by your employee, your payroll officer or whoever it is, then if it's on you, then I would be inclined to lodge an SGC statement saying there was a typo in the setup of that employee in payroll or anything. Then I would be inclined to lodge an SGC statement. If it's an error by someone else, so it's outside of your control as an employer, I personally would be okay to let it run and leave it. But it ultimately comes down to each person's risk perception, basically. But yeah, I would be, as I said, if it's outside of my control as an employer, and even as an accountant, as a director advising my staff, if it's out of their control, I would be okay to leave it and just rely on the fact that it would have been paid on time. Greg's asked, my son has a full-time job and occasionally he works casually weekends and public holidays on the farm. What are your super obligations? I think, Greg, you would need to still pay him. Have a look, go back to that award on the casual side of things. But again, as I said, there's no real minimum for super anymore. So if he's working for you on the farm and you're paying him a wage, you still need to pay his super. Obviously, as we might know, as some people may know, there's different ways in which you can remunerate someone, whether it be profit distributions or otherwise. Then, you know, if it comes through as some other form of remuneration other than a wage, or other than ordinary time earnings, then you don't have to worry about super. But yeah, if you're paying him a wage and if it's reported through payroll, then you should be paying super to him as well. So I think that's all the questions that's on there. I will come back to that RDO question, and I'll put an answer in our follow-ups in the next couple of days. But yeah, as I said, I'll come back to questions at the end of the webinar again. So please feel free to add some more in there. The first section's taken a bit longer than I thought, so we did book an hour and a half, but yeah, we should be okay. So the next one is fringe benefits. So fringe benefit is basically anything provided to an employee or their family or an associate other than wages. So it's anything on top of their wages, okay? And ultimately, if you do that, there's a potential that you have to pay fringe benefits tax. And fringe benefits tax is hefty. It's at the top rate of tax. So it's at 47%. Okay, and I'll run through briefly in a sec how it's calculated, but effectively, it's not exact, but it's fairly close. Whatever the value of the benefit that you provide to that employee, that is roughly what you're going to be paying in FBT as well. So if you give a weekend getaway to an employee for $2,000, you're pretty much going to be paying it. It might come out to be about $1,900 in FBT. So as a guide, I generally say whatever benefit, or generally say to a client, whatever benefit you're intending to provide to an employee, if it's caught by FBT, you're going to be paying that again in FBT. So it's pretty hefty, because it's effectively assuming that employee is on the top tax rate, and you're giving them that benefit and not paying them in a wage. So it's pretty high. The ATO does have data matching capabilities, as they do with STP and SuperStream and all of that. They've got it's very much Big Brother. You know, if your W1 figure, which is your gross wages on your BASs, is high, so if you've got a big payroll cost, the ATO generally draw the conclusion that if you've got lots of staff, you're likely going to be providing some form of fringe benefit. Vehicle purchase records, I know, and I've had a few instances where a client might have bought a car in a company that's running a business, so we'll say a luxury car, and the ATO can see that it's not a work ute, it's a sedan or whatever the case is, and they can cross-match that. So the Department of Transport effectively reports that to the ATO. They can then see that Joe Bloggs Proprietary Limited has bought a Mercedes-Benz in their company. We're going to go and have a chat to him. So they are very much they Big Brother with FBT. It's important to note, though, that not everything is subject to FBT. So I'll go through it in a sec in terms of the common fringe benefits. But I know we've got a few people join the webinar down in Esperance and the regions. There are a lot of exemptions for regional employers. Okay, not with every type of benefit, but with certain benefits there are some exemptions. Okay, so Common fringe benefits to provide provided to employees: providing a car. There's an important distinction. I was actually having a chat to Glenn Waldock, the other director in our business services team yesterday, and the ATO just gets so nitty gritty, or so sort of down to the finest things, that they actually define what a car is and what a vehicle is. Don't know what the difference is personally, but in terms of practically what the difference is, but there's a definition that the ATO has as to what a car is and what a vehicle is. Okay. A car would be, in this instance, would be like a sedan or a non-work vehicle. Okay. Providing free car parking to your employees, potential fringe benefit. Car parking, there are exemptions depending on where you are and things like that. But technically, providing a car park to your employees is a fringe benefit. School fees, any expense paid on behalf of your employees. Gifts, entertainment's a big one. The other one that's not on there is rent. Okay, so paying rent for an employee. So, we'll often have clients that say, we're employing staff, there's no housing in the area, we've managed to secure a house, we're going to pay for that employee's rent. That's a fringe benefit. Again, there's exemptions for that in remote areas, but if you're in Perth and you're or Bunbury or a regional centre, and I'll touch on that in a second, you're paying rent for your employee, there's fringe benefits on that. Okay, so again, I'll just show you this quickly, where the certain fringe benefits have exemptions, whether they are remote or non-remote. Okay, so rent's an example. If you're renting a house for an employee and that lease is in your name, so the lease is between the landlord and you as the employer, and you're in a remote area, then it's 100% exempt. Okay, if the lease is between the employee and the landlord and you're paying the rent, it's 50% exempt if they're in remote. So you can see here, as Albany, Australind, Bunbury are all non-remote. So there will be no exemptions there, but Dunsborough, Esperance, Kalbarri, Kalgoorlie are all remote. So the list of remote areas is pretty generous. So it's worth looking at that. But as I said, rent's a fairly common one. So if you are renting for an employee and you're not sure, touch base with us and we can run through whether there's FBT or not. Okay. Exemptions. Basically, if there's a work, it's the term they use, if it's otherwise deductible. Okay, so if you're paying for something that for your employee that would normally be deductible if they were to pay for it, then it's exempt. Superannuation. If the employee comes and says, hey, can you provide me an extra $1,000 a month for super, that's exempt from FBT. Okay, or if you say to them, I'll give you an extra $1,000 if you come work for me, and it goes into the super fund, it's exempt. Work-related items, so laptops, smartphones, electronic devices, iPads, the like, as long as they're predominantly for work use, and there's annual limits. So it's based like with portable electronic devices, they call it, so smartphones, iPads, it's one a year. Unless you're replacing one. So if they've lost it or smashed the screen or something and you're replacing it, it's one a year. Okay. And minor fringe benefits. So minor fringe benefits are a big one, where they are one of the things that we rely on the most to get around fringe benefits tax. Okay. And effectively what they are is it's any benefit that is provided to an employee, or I won't say any benefit, it's most benefits that's provided to an employee where it is less than $300 in value. So if it's $300, it's a fringe benefit. If it's $299, it's not. Okay. As I said, there are certain exceptions where the minor benefit rule doesn't apply, but as a guide, that's the threshold. The other one to bear in mind is that it's infrequent and irregular. Okay, so you can't go and say, give a $290 gift voucher to an employee every single month for being a top bloke. That's deemed something that's regular because it's expected and it's every month. So even though it's under that 300, because it's regular, it's still considered a fringe benefit. Okay, that $300 limit is per type of benefit, even if it's in conjunction with each other. So a good example with that is a Christmas party, and we're obviously mid to late October already, which is scary. So I think a lot of people are organizing Christmas parties and the likes already. But with a Christmas party, you can technically go and say, okay, well, I've paid $290 for the food and drink package per employee. I've paid $100 per employee for the band or for the entertainment, and I've paid $50 per employee for the venue. Even though combined they are over $300 in total per employee, per benefit being the food and drink, the entertainment, and the venue, as individually they are less than that 300, it's a minor benefit. So that's important to note as well. And lastly, the benefit provided to an associate, so a spouse, for example, is not included. Like they don't get the minor benefit exemption. Okay. So how does fringe benefits tax work and how is it calculated? Okay, so they are, and I'm going to go over this reasonably quickly because I think, generally we are the ones who work out what the FBT is, but it's important for you guys, for everyone to know how it works so they can work out what they're up for. So whatever benefit is provided, we gross it up by those rates there. So, and it depends if GST is claimed or not. So if there's no GST, we claim it, we gross it up by the, got to get this right, the lower rate. Whereas if there is GST, we gross it up by the higher rate. Okay, so if you're providing $1,000 getaway to someone for a weekend away down south, then we gross it up by, say, the 2.08, and that so it goes to just over $2,000, and then you pay 47 cents in the dollar on that. So then it comes down to, as I said before, that sort of the $900 figure or thereabouts. So you're almost paying the same again in FBT than you are in the actual benefit itself. You need to submit, or employers need to submit, an FBT return. So it's a completely separate return that we lodge with the ATO. It's the FBT year runs different to the tax year for some reason. It's from the beginning of April through to the end of March. And I think us as tax agents, we get until, I think it's late May, early June to lodge and pay that FBT. If you were to do it yourself, I think it's pretty much late April. So we get a bit longer just because we're a tax agent. But generally, you've got to lodge it in that April, May every year, lodge and pay. So providing cars. Okay, this is a big one. As we know, most employers do provide cars to their employees. Again, as I touched on before, there's a distinction between what's a car and what's a vehicle. Generally, a vehicle is a work ute, basically. Okay, and there's more exemptions on that than there would be on a car. So the distinctions or the classifications come down to the carrying capacity of that vehicle, okay, and also whether it's principally designed to carry passengers. So carrying capacity, can it carry more than a ton? So and that's the payload. Effectively, that's what you can put in the back of the ute. That enables it per the car specifications that is provided by the manufacturer. Can it carry more than a ton? Okay, that's a trap, or there is a trap there, because you need to be very careful there, because a lot of manufacturers these days market their cars as being able to carry a ton. But if you actually look at the specifications, they actually say that the carrying capacity is 990 kilos, less than a ton, subject to FBT. So you've got to be very careful there. To actually look at your specifications for the exact model that you have, or exact model that you're buying. We often get this question. Your standard Hiluxes, Ford, I've gone blank. I drive a Toyota, so but your standard Hiluxes are Ford Ranger, that's the one, are fine generally. We're getting a lot of questions about the big Ram utes and things like that. They, in terms of the carrying capacity, they are not fine. Okay, so you've got to be very careful with those sorts of utes. That second one, whether it's principally designed to carry passengers, there's actually a formula that the ATO has, which we work out based on the number of seats and so on. So really, my advice is, if you're looking at buying a new car, providing a car to your employee, just touch base with us and just make sure that we're all okay there. Okay. Another important thing to note is even if we tick the box for being okay because we carry over a ton, there's still a notion that the private use still needs to be minor and infrequent, basically. So they let you take the car, you're allowed to take the car home and keep it over weekends and that, but the ATO says that theoretically you should still only minimize that private use. Okay, that's hard to track. I think they do have a suggestion about keeping a calendar of the private use and things, but particularly for dual cabs and the likes, if it's a work ute, like a workmate or whatever it is, you should be okay. But if it's a Hilux SR5 or top of the range Ranger, whatever the case, theoretically you've got to still minimize that private use. That next point there is important. Whether the vehicle or car is available for private use is important. So this is an interesting one where, again, available is a defined term. So if you have a work car and it's kept on site, so it's locked at the office every night, employees don't get to take it home for the night, and it stays at work, but they get to use it whilst they're at work. But they take the keys home with them, or the keys are easily accessible for them outside of work hours. That's available for private use, and there's FBT on it. So locking up the keys whilst it's not being used outside of work hours, making it not available is important. Okay. And then with the ways FBT is calculated on them, so a logbook, we've got to keep, or you as the employee or employer has to keep a logbook for 12 weeks, so 3 months. Or if you can't be bothered keeping a logbook, there's what's called the statutory method, which the FBT is payable on 20% of the car. So if you buy a Ram Ute that doesn't qualify as a vehicle and is subject to FBT, and it costs 200 grand, you're effectively going to be paying 40 grand in FBT. Okay, so as you can see, the higher the cost of the car, the bigger the impact. Logbooks generally are better and calculate less of a FBT cost, particularly obviously if it's a high logbook percentage, business use percentage, but not everyone can be bothered keeping a logbook for 12 weeks. Yeah. Salary sacrificing. Again, this is common at the moment, and salary sacrificing a benefit, so a fringe benefit. So as I said earlier, salary sacrificing super is not FBTable. but salary sacrificing car potentially is. Okay, often done, and it's done more and more common these days, or it is more and more common, just for recruitment and retention, staff retention benefits. Yeah, important to look at because a lot of employers these days are offering them. Cars have become less attractive since 2011. It was a while ago. That, just without getting into detail, that statutory rate previously, so it's at 20% now, and previously it got down to 7%. So based on the level of Ks that you're expected to do. So historically they have been very attractive. Now salary sacrificing cars, depending on each person's circumstances, are still attractive or can be attractive, but less so. Again, we have to report them on our, it's got payment summaries up there, but our earnings summary to the ATO, as we did with that reportable employee super. Okay, so exact same purpose as it was for risk, where not taxable to the employee, only affects government payments, HICS repayments, child support, that sort of stuff. And you only have to do it if the taxable value of the benefit is more than $2,000. Okay, so if you are giving an employee a 50th birthday present and you give them $500, whether it's a $500 weekend away or a gift voucher or anything of the likes, then it's still taxable with FBT, but it's not reported on their earnings summary. Entertainment is the most common by a long way and probably the most understood. So there's actually two different types of entertainment as far as the ATO is concerned. Meal entertainment, which is done by way of food or drink, and recreation. Okay, meal entertainment, as we'll see, is a lot easier to get around the FBT cost, whereas if it's deemed to be recreation, it is a lot harder to get around. If that benefit constitutes entertainment, then it's likely to be subject to FBT. And that literally comes down to, are the employees expected to enjoy themselves at that event or by you, due to you providing that entertainment? So it literally comes down to, are they there just to get through the day in comfort, or are they expected to have fun and enjoy it? If it's the latter, likely going to be FBT on it. Okay, so different types of recreation. Examples are theatre tickets, golf at some fancy golf course, sporting event tickets, a joy flight, harbour cruise, something away, something done by a third-party provider. Obviously, if you're going to send an employee on a joy flight or to the footy or whatever the case is, the expectation is that they're going to enjoy it, and therefore it's likely going to be FBT. So if it's recreation, FBT will likely apply. Entertainment by way of food and drink, it comes down to the age-old why, what, when, where. So, why is it provided to the employee to complete the working day in comfort, as opposed to them enjoying it, as I sort of touched on before? What are you providing to the employee? The more elaborate the meal, the more likely it's entertainment. So, if you're just giving them Subway as opposed to a 3-course meal at a fancy restaurant, the Subway is less likely to be entertainment, whereas the 3-course meal is alcohol provided with the meal, and so on. When is it during or outside of work hours, and where? Is it at a work premises or outside at a fancy restaurant? And we need to look at all of those in conjunction with each other. So it's not necessarily saying, it's outside of hours, but we're on site, but we're getting caterers in and everything. You've got to look at all of them and in conjunction with each other. The common one that we often get, or that often comes up, is like toolbox meetings, for example. You might have a toolbox meeting at 4 o'clock on a Friday afternoon, or whenever it is for that matter. Why? A lot of the time you're discussing some work matters. It's often small sustenance more than anything. You're not providing a 3-course meal at a toolbox meeting. Yes, you've probably got alcohol. You may have alcohol. You might have put a case of beers on, but it's not substantial or whatever the case is. When often during work hours, potentially at the end of the day or at the start of a day, and where often on work premises. So toolbox meetings are generally smaller scale on site, and therefore I would be happy to advise a client that generally they wouldn't be subject to FBT. Whereas if you're taking your staff out for a dinner on a Friday night, probably yes. The Christmas parties, these, as I said at the start, coming up. So we've just got to be cautious of the FBT impact on them. I will start by saying that most clients obviously provide some form of Christmas party to their staff, which, based on that, theoretically, we should be lodging a whole lot more FBT returns than we are. What we tend to rely on is that minor fringe benefit, because for an employer providing a fringe benefit where the cost is more than $300 per head for a Christmas party, bearing in mind it can be per item, it would have to be a fairly substantive Christmas party. Okay, so this slide goes through where they're held on the premises. So as we know, if it's on the premises, it's unlikely going to be FBT, but we've just got to bear in mind that it's not tax deductible and there's no GST claim with it. Okay. If there's partners attend, the distinction here is whether it's on the premises versus off the premises. Okay. Partners, again, it comes down to cost per head. If it's less, then there's no FBT, no deduction, no GST claim, as it would be for staff. If it's more than 300 per head, then there is FBT, deductible, and GST. Okay, so generally speaking, where you're paying FBT on it, you can claim a tax deduction and you can claim the GST. Whereas if you're not paying FBT on it, you can't claim a tax deduction or GST. Okay. And then with suppliers and clients, no FBT, but again, no GST and no deduction. Okay. This is very general, so yeah, just be careful and touch base if you've got any specific queries with your Christmas party. Okay. I'll just skip one ahead just for continuation. So again, or where you've got a Christmas party off premises, more likely that FBT will apply. Okay, so again, we will be relying on that minor benefit. So where you've got staff and it's costing you $200 a head, there's no FBT, but again, no tax deduction and GST. Similarly, if it's more, you are paying FBT and you are get to claim everything. And partners are the same. And clients are similar to whether it's on or off the Christmas party. Okay. With food and drink, so this is how we work it out. There is the actual method. So you look at what you've actually spent on food and drink and meal entertainment. A 50-50 split, which is where you literally take all your FBT or all your entertainment costs, divide it in half and pay FBT in half of it. It's a lot of that. A few clients use that when they provide a lot of entertainment and it's just too hard to go through and actually work out who was attending the event, what the cost per head was and everything. It's split in the middle, you pay half FBT and half of it. And a 12-week register, which is where you work out, you keep a roster over that 12-week and you work out the split between staff and associates and clients and come up with a percentage, and then you apply that percentage to your annual cost. Okay. The important thing to note is, as I said earlier, that minor benefit is very valuable. We use it a lot. If you use a 50-50 split, you don't get the minor benefit. So I've had clients where historically they've done 50-50 because it's hard to work out who was there, and it was tricky, and they were paying 50% or FBT on 50% of it. We've then turned to them and say, well, let's do a bit of an exercise, spend a bit of time analyzing the actual FBT or the entertainment costs, and went actual method, and we found that we weren't paying a cent in FBT because we were relying on that minor benefit. I've been talking about minor FBT. As I said earlier, tax deductibility and GST, generally, where you're paying FBT, you get a tax deduction and the GST claim. Where you're not, then you don't get the tax deduction and you don't get the GST. So you'll often find, I'm sure a lot of you see when we're doing the financial statements at the end of the year and doing the compliance work, we'll actually go through and afterwards you might find we often give you a GST adjustment to make, saying, you owe the ATO X dollars, please add it to your next BAS, or the other way around. A lot of the time, we find that clients are claiming GST on their entertainment, whereas they shouldn't be. So just something to note there. I've been through that one, so I jumped around a bit. Christmas gifts. So again, lots of employers give gifts to their employees. If it's something like a bottle of wine, hamper, perfume, gift cards, voucher, whatever it is, they're expected to enjoy it off-site. If it's less than $300, again, there's no GST. This is a bit different with gifts where you can claim the tax deduction for it and you can claim GST because they're enjoying it off-site, whereas as opposed to meal entertainment, which is a bit different. Again, sporting tickets, concert tickets, the likes, recreation. There's no FBT on it if it's less than 300, but we can't claim the GST and a tax deduction. Okay. So common one is vouchers, gift vouchers. Byfields do it for our staff. It's fine. As long as they're less than $300, we can claim the tax deduction for it, and we can claim GST on them as well. Lastly, business lunches. I think I can see some queries on that, but they are classified as entertainment. Okay, so we'll get a lot of clients saying we're taking our clients out for lunches. Is it deductible? Is it, what happens with it? So it's still entertainment, which means that we look at which staff we're attending, and FBT does apply unless it's $300. If it does apply and you're actually paying FBT, then we can claim a tax deduction and we can claim the GST. Whereas if it's less than $300, so we're relying on that minor benefit, then there's no tax deduction and no GST. Okay. For clients, there's no fringe benefits tax on it, but it's not tax deductible and there's no GST claim. So you can still do it, and it's not going to cost you anything extra, other than the fact that you're not going to get a tax deduction for it and you're not going to get a GST claim on it. So I think that's pretty much everything. 10:20, so almost spot on time. So I'll go through some of the questions again, and I think I've hopefully answered some of them. So our client lunches with a cost of under $299 per person considered entertainment, but a non-deductible expense. Yes, as I said there, yeah, if you're taking clients out, it can be more than 300, and there still won't be fringe benefits. But no matter what the cost is, taking clients out for lunch is not deductible and not GST. Look, there's always an argument and discussion with clients saying, well, it's PR, we're trying to grow our networks, we're trying to, it's got a nexus to the income because we're keeping clients happy. Yes, I agree with that and I understand that. ATO, less so. So I think, again, comes down to your risk perception, as I said at the start. If you're going out once a week and your entertainment cost for clients is tens of thousands of dollars, more risk. If you take a client out once a year or twice a year and you're spending $1,000 on it for the year, less risk. Okay, but no FBT, but no deduction and no GST. Okay, and the same, that next one on the same theme, do employee lunches fall into the same category? Yes, but FBT applies if it's over the $300 per head. Is a coffee catch up with a client considered the same? Again, it's a tricky one. Less substantive, less cost, less risk. Technically, I would say yes, but I would, if it's not few and far between, but if it's less common, then it's less risk of being caught. So, I'm sure the ATO are generally fairly reasonable when it comes to that sort of thing, where if you take a client out for a coffee occasionally and buy them a sandwich or snacks or whatever, then I think it'll be fine. Whereas if you're going out to phrases in the city for lunch, then there's likely going to be, it's more going to be an issue. Yeah. Gift cards and or presents to employees under $300, are these tax deductible or non-deductible? For example, an employee having a baby. So gift cards specifically, yes, they are deductible. Okay, so I think I touched on that before. As long as they're designed to be enjoyed off-site and away and at home. So, that the employee having a baby and you give them a $100 gift voucher or whatever the case may be, then yes, it's fine. It's all good. Okay, I think on that one. And then lastly, is providing workwear subject to FBT? No, it's not. Okay, so that comes down to that otherwise deductible rule. So if you're providing anything to an employee that would ordinarily be deductible to them or to you, there's no FBT. Okay, so workwear, I suppose I should probably define that. Like, if I was to try, if Byfields was to try and provide, to give their staff a business shirt, for example, with no logo on it, then the ATO says that there's no real distinction between that business shirt being related to the work that we do. Whereas if I've got a mining services client and they want to provide steel cap boots to their employees, that is very specifically used in their employment. Okay, therefore not deductible. So in terms of workwear, if it's deemed to be used in their employment and there's a nexus between the income that they earn or the income that you make as an employer and that item being provided, so workwear, safety glasses, steel cap boots, that sort of stuff, fine. There's no FBT, and you can claim the costs, and you can claim it's tax deductible. You can claim GST. It's all fine because it's seen to be deductible ordinarily. Okay. So that's the last question on the Q&A side of things. I will touch base. So as I mentioned at the start, we're going to be running these webinars, pretty much try and do them every quarter. So they'll be done by myself and Glenn, the other director here in Perth, the business services director in Perth. So our next session is going to be on the 12th of December. We thought it would be good to get it in before Christmas, and ordinarily it might be January, but we know a lot of people go away in January and are busy with kids after school holidays and the like. So Glenn's going to be going through family trusts. So family trusts are a very common structure that we use, and often have discussions with clients on them. So Glenn will touch on how they work, ownership of them, succession, how they're taxed, and any current issues, which there are quite a few of them at the moment, as I'm sure your accountant was hopefully mentioned to you. So stick it in your diary. We'll get invites out again, probably a good few weeks before that, and there'll be some social media ads. The registration's open now if you want to do this. So if you want to sign up, so that will be coming up. After this, probably in the next day or so, we will get these slides out to everyone on an email, and I'll answer that question about RDOs and whether they're considered ordinary time earnings. And if you've got any other queries, please touch base. I'm happy to help. And any suggestions on topics, if there's something that you feel strongly about listening to or hearing about, please touch base. We've got a few lined up, but happy to take feedback, and we'll go from there. So thank you everyone for joining me. I hope it all went all right and you learned a few things, and look forward to the next one. Thanks everyone. Bye.